Hi, this is Jessica Dunn, and we're going to discuss cost of capital. Cost of capital is critical in many business decisions. It's necessary to determine whether to take on new projects, what compensation plans to use, because often bonuses are paid based on the company's return on invested capital. Um, and it's important when choosing the balance between debt and equity. Cost of capital represents the firm's cost of financing, and it is the minimum rate of return that a project must earn in order to increase firm value. Financial managers are ethically bound to only invest in projects that they expect to exceed the cost of capital, so that are going to improve firm value. Cost of capital looks at all of the firm's financing activities, not just a single portion. So, for example, if you were going to finance a new project with debt, you would have to consider not only the cost of the debt that you were planning to use, but also the cost of the equity, because once you use that debt, it's no longer possible to use it for future investments. Most companies are going to try to maintain an optimal mix between debt and equity. Too much debt is bad because it increases the chances of bankruptcy, but too little debt is bad because you're not getting the optimal tax benefits. So, to capture all of the relevant financing costs, assuming some desired mix of financing, we need to look at the overall cost of capital rather than just the cost of any single source. Capital components are sources of funding that come from investors. Accounts payable, accruals, and deferred taxes are not sources of funding that come from investors. They come from operating decisions, so they're not included when we talk about the cost of capital. Accounts payable, it and these accruals and deferred taxes increase automatically as sales increase. So the impact of payables and accruals is incorporated into a firm's free cash flow, but not the cost of capital. Whenever we're talking about capital costs, we need to discuss whether the tax implications are substantial. When we're calculating the cost of capital, we use the after-tax cost of debt because the interest expense associated with debt is tax deductible, and so it lowers the cost of using debt. The cost of capital is primarily used to make decisions which involve raising and investing new capital, so we should focus on marginal cost. We're going to use the weighted average cost of capital to compare a project's expected future returns and the cost of the new capital required to finance this project. So we're going to be looking to see, is the project going to yield a great enough return to compensate us for investing in this project? And to do so, we're going to use the weighted average cost of capital. The weighted average cost of capital looks at all the sources of financing, so debt, common stock equity, and preferred stock equity. It reflects the average future cost of capital over the long run. And so we use all three of the different capital components and multiply them by their weights in the target capital structure. So our weighted average cost of capital is equal to the portion of our capital structure weighted in debt times the cost of debt times 1 minus the tax rate. And we only use 1 minus the tax rate with the debt associated with it because the interest on that debt is tax deductible. Then we add to that the weight in preferred stock times the cost of preferred stock plus the weight in common stock equity times the cost of common stock equity. Now we do have to look at 100% of the capital structure, so all of the weights do have to sum to 100%.